Everyone, it's Nick with Us versus Her. Today we're going to go over how to buy a Strangle trading options on Robinhood. So if you're not yet a subscriber, hit that subscribe button. We also do live videos Monday through Friday, 3:30 p.m. Central every day. If you want to get notifications of that, hit the bell button. If you're not yet a member of our free options trading group, the link below is for that as well. I post all my trades in there. But for right now, let's get into it. So I'm going to open up a liquid stock here. I'm going to open up Apple to trade options on. And if you don't know what a strangle is, basically a strangle is you're buying a call and you're buying a put for the same expiration, but different strikes. It's different from a straddle. A straddle would be you're buying a call and a put at the same strike. So that would be, let's say I bought for October 19th on Apple, a straddle would be I'd be buying this 220 call and I'd also be buying the 220 put. A strangle would be I'm buying two different strikes for the call and the put. And the reason why you want to do that is because sometimes you may be thinking like, hey, let's say Apple, I think Apple's going to go up, but you're not entirely sure, so you buy a put to kind of hedge yourself and to protect yourself. So a lot of the times what I like to do is kind of have a bullish or bearish skew depending on what you think that the stock is going to move. So like right now, let's just say Apple's going to have a bullish move by October 19th. That's 1 week away. Today's expiration Friday. They don't allow you to today's October 12th. They don't allow you to trade options on the day they expire in Robinhood. Just so you're aware, you can close if you had positions closing today. You could actually open those. You could actually close those, but you can't open up new positions today. You can't actually day trade on expiration Friday on Robinhood. They do that just to protect the broker. So we're gonna go with October 19th here. And what I would do. So let's say I think that it's going to be bullish. I would look for some option pricing. Right now we're on the call side, or I'm buying. We're just buying stuff. We're not going to short anything. So we're going to buy. Let's say right now the stock price is 220, and let's say I think that the stock is going to go to like 230 next week. I'll buy this 227.50 here call, and then you just add it here, and then I'll buy a put to kind of protect myself. Whoa. All right. And then we'll buy a put. As you can see, the puts are pretty expensive. So for this, we'll buy something. Obviously, like when you put a strangle on, it's all about pricing. So make sure you're getting good pricing. I'm not going to go over pricing in this video. I'm just showing you how to put the trade on. Obviously, when you're putting a trade on like this, it's all about the pricing and making sure that the direction that you want it to go, exceeds the price. So what we want to do here, let's just say to protect myself. So we got a $7 up. Let's just do to protect myself. We're gonna do like $2.05, $15 down, just to put a cheap strangle on here, just to show you what that looks like. And actually, Robinhood actually identifies this as a strangle now, as you can see here. So you know that you did it right when Robinhood says, hey, you got a strangle on here. It's gonna cost you $1.48. Typically, like for my strangles, I probably wouldn't put this on because it's pretty wide. Usually I like to be a lot closer to the money. IV's pretty spiked up right now due to the volatility in the market. So, if you're trading right now, you can understand that. Typically with strangles, I like to be closer in the money so that way you can capitalize on the moves a lot faster. And right now for next week expiration, they're a bit expensive. But typically, like for a strangle, I'm looking for $1.50 to $1.50 in total cost, and mainly because if it moves $1 or more in my direction, I'll be able to make 100% profit. Is kind of my targets here. So putting on like a $4 strangle is not really my thing. I wait for options to get a little bit cheaper. Right now it looks like I'll be selling some premium in here instead of doing that. But I just wanted to show you how to do a strangle in Robinhood. It's fairly easy. The concept's fairly simple. Just a lot of people get confused on what you should do. And this is kind of like a hedge position. So, this is I have $7 to the upside here. So I got this 227.50 call. Right now it's 220. So I'm bullish. I'm skewed to the bullish side, but I have this protection. If it does drop down to like 205, 210, I'll either be able to get out for break even or maybe a small profit. So that's kind of what you want to do, what you're kind of look at. Like a lot of times, like right now, if I put a strangle on, let's go to the call side here, and let's do something like the 220.50. Right now it's in between strikes, with the $2 wide. Let's just say we did this and we did the put a 220. So we're in between strikes right now. You know, you're not going to get the best deal here because you need it to move like more than $6 for it to go your direction. Yes, it could happen, but you're putting a lot of risk on the table. And let's say Apple's flat next week, this premium is just going to get crushed to zero. So that's why you try to keep, like for me, for Strangles, I try to keep a low risk, high reward kind of scenario here. So I just wanted to go over that real quick. If you guys have any questions, leave a comment below. If this video was of value to you, appreciate you if you hit that like button down below. It really helps my videos out a lot. You guys have a great day. Thank you so much.